Everyone is talking about how to survive a stock market crash lately because of this big hype around AI. But here's the thing. Yes, I talk about potential for crashes, and as we get more overvalued, the chance of a crash is high. But a lot of people use that word in these videos to get you sucked in because it sounds scary, it's dramatic, and honestly, it is used way too often. The truth is, crashes are rare. In the last 25 years, we've only seen two real longer-term crashes, 2000 and 2008. Yes, we had a 2020 COVID crash, but as you remember, it lasted about 4 weeks and we finished the year at new highs. Now I'm going to give you the answer up front because it's nothing to fear. When stocks are selling below what they're actually worth, that's when you buy. That's when the true smart money steps in. If you're investing in individual stocks like I do, you look for deals, companies that are on sale. And if you're an ETF investor, like me, you just keep dollar cost averaging no matter what. And when the market falls below fair value, if you have a little bit of guts, you throw in a little bit extra cash. That's how you not only survive a crash, but you profit from a crash. But don't click away now that I've given you the top level strategy. There's far more to it. And once you understand the nuance, you're never going to be in the fear of stocks falling. And your emotions won't lead you to make bad decisions because that's what causes underperformance. Bad decisions during emotional times, whether it's euphoric, let me buy everything that's awesome, or despondent and depressed because the world feels like it's falling apart. So the goal of this video is to help you understand that you should never be afraid when stocks fall. You should look at it as opportunity because that's what it is. As Morgan Housel says, every past stock market crash looks like an opportunity. Every future one looks like a risk. Guess what? They're all opportunities. And instead of focusing this whole video on a big market crash, which again, doesn't happen every year, I want to shift gears and talk about something that happens way more often. When a stock you own, an individual stock, suddenly plummets. This is far more common, and it's more important to understand. So I'm going to walk you through an actual plan, how I handle it when a stock I own falls, so that you understand when it's time to hold, sell, or buy more. And guys, keep in mind, if you're only investing in ETFs, it's still important to understand this because the more you watch our channel, you're going to gain some confidence to maybe buy individual stocks. And if you can handle and understand that when a stock falls in half or more, you'll definitely be able to handle the stock market in general falling in half. That's far easier to handle. So here's some perspective. For the entire S&P 500 index, a drop of 30% or more very quickly, which is what people love to call a crash, it's actually pretty rare, as I mentioned at the start of the video. Since the 1950s, it's only happened 6 times. That's once every 12 years on average. But here's the kicker. Individual stocks, they fall 30% or more regularly. It's not rare, it's normal. Guys, let me show you. Let's pull up the top 7 stocks right now. NVIDIA, in the last 1 year. High right here of 152, the lowest low was 86. That's well over 30%. That's all in the last 1 year. Let's pull up Meta. Look at this. A high, 740, a low, 480. Well more than 30%. Okay, let's pull up Microsoft. Last 1 year. A high here of 447, a low here of 350, 30%. Let's pull up another one. Tesla, a high of 483 and a low of 220, far more than 30%. Guys, you see the volatility just in the last year. A company might miss earnings. They might have some bad news that hits the headlines. The whole sector falls out of favor. Or people in the market just throw a tantrum. It happens all the time. Whatever the reason, this happens every single year. And it's happening right now. Guys, just 6-7 months ago, Intel was at $18 a share. As of yesterday, it's $44 a share. This is a company that's turning around, hasn't made money in a while, isn't doing great. And it's up from $18 to $43. Just like it can go up 30%, 40%, 200%, it can fall very easily. As of today, 24 stocks in the S&P 500, so about 5% of them, are down 30% or more just this year alone. That's not even counting all the companies outside of the S&P 500. That doesn't even include the stocks that fell 30% and bounced back, or companies like Palantir, who returned 132% this year, but still fell 30% from their all-time high. So even in any year, when the overall market might be doing fine or great, plenty of individual stocks are getting hammered. This is way more common than most people think. And chances are, if you're invested in individual stocks, you've either been there already or you will soon. That's why this video matters. Warren Buffett famously says, if you can't stomach a stock you buy falling 50%, just buy ETFs. And guys, it is hard. I don't even know how many stocks I've had fall in half, but a lot. Guys, when you buy a stock, you sit there and say, in fact, with Michael Burry, one of the best stock pickers of all time, before he became famous for shorting the real estate market, his investors said, Michael's great at buying a stock, watching it fall 50%, and then watching it go up 10 times. So even when he bought a stock that he was right on fundamentally, he still saw it fall. This is the hard part. How many of my stocks have fallen in half? I don't even know. Frankly, I don't care. So guys, what I'm teaching this channel is understanding what you're buying and how to value a stock. You value a stock by valuing the business. So that if the stock falls in half, like when it happens with me, I don't look at it as fear. I look at it as great opportunity to buy more of that company at a cheaper price. Guys, successful investing is not done up here. It's done over here. Yes, you have to have some understanding of numbers, but we can teach that very quickly. What I can't teach you very quickly and flip a switch on is how do you handle it when the market falls, when an individual company falls. Investing is scary. There's no denying that. When your stock goes down 30, 40, 50%, your brain goes into overdrive. Did I mess up? What did I miss? Should I sell before it gets worse? What if I lose everything? That's all panic. It's totally normal. But my goal here is to make investing not scary or less scary, because the best investors aren't the ones with Ivy League degrees or Wall Street suits. They're the ones with the strongest temperament, the strongest stomachs, the ones who can stay calm when everything looks like it's falling apart. You've got to work on controlling your emotions. That's the number one skill in investing. Not stock picking, not reading charts, not timing the market. Emotions. Because when things fall, which they will, your emotions will scream, do something. But that's when you need to do the opposite. You need to pause, you need to breathe, and you need to follow a proven process that'll help you make better decisions. Now, back to market crashes for a second, because when those rare events do happen, something else shows up. Nearly every stock will fall, and they could all start to look cheap because of the fall in stock price. Guys, I own companies today. I own 28 companies today, and a lot of them I consider to be undervalued. But if you told me tomorrow the market was going to fall 50%, those 28 stocks, I'm quite sure would all fall along the way. Just because something is undervalued doesn't mean it's going to go up immediately. This is very key to understand. Your goal here is to not sit there and say, oh, I bought cheap stocks, therefore it's a hedge against the bad market. No, in all likelihood, they will probably go down less than the overall market, but they're still probably going to go down. And here's the key. Not all cheap-looking stocks are cheap or good investments. In a crash, the whole market can look like a clearance rack, but just because it's on sale doesn't mean it's worth buying. Go back to all the EV stuff. When the EV companies were down 95%, guess what? They were still junk, and a lot of them went to zero. Back in the dot-com era, all these dot-com companies with no revenue and all these losses, they fell 98%. Guess what? Still went to zero. Just because something is cheaper does not make it cheap. You've got to know how to separate the good business from the junk. You're putting your hard-earned money in these companies. That means you need to be able to say, this company is worth it, I understand it, it's undervalued, and I'm in. If it gets cheaper, I'm able to reevaluate and buy more. That's what we're going to walk through next, how I actually handle it when a stock I own drops. Because we want you to know exactly how to handle it when your stocks fall and identify when it's okay to buy more and when it's time to walk away. And that's what we're here to teach you today. Now, a lot of these principles are going to be very applicable to you. But remember, you're going to invest best when you invest in things that make sense to you. I'm going to show you the examples that make sense to me. Now, let me take you back to the year 2000, because this is really, really important. I'm going to pull up my favorite stock to talk about. Now, of course, Cisco is a great lesson in stock market performance and valuation. Why? This was the NVIDIA of 2000. This is one of the NVIDIAs of 2000. There were several. Back then, it wasn't just a tech company. It was the tech company. In March of 2000, Cisco became the most valuable company on the planet at $500 billion. Guys, $500 billion. We laugh at $500 billion today. It surpassed Microsoft. Everybody thought Cisco was unstoppable. Does that sound familiar? But then, boom, dot-com bubble popped. The hype collapsed. Look at this run up, guys. Boop, boop. Major fall. Guys, Cisco went from $82 a share to around $8 a share at its low. That's a 90% drop. That's bad. Now, if you're looking at the stock price, what do you think of the company right here? You're thinking to yourself, this company's crap. But guess what? Quite the opposite. But the stock went from hero to zero in a matter of no time. A company that everybody loved, everybody wanted, everybody said you have to have this, crashed. And here's the part that'll blow your mind. Even today, 25 years later, Cisco has never gotten back to that all-time high they hit in 2000. Let me repeat that. Never gotten back to that all-time high. And it's not because Cisco turned into a bad business. Cisco still dominates networking. Their equipment is everywhere. Their certifications are industry gold. The company kept growing. The profits kept coming. The revenue kept increasing. But the stock right here was priced for perfection. Investors had assumed that Cisco would forever grow at insane rates. When reality set in, the stock tanked, and it tanked hard. Worst yet, when the dot-com boom died, so did demand. Companies stopped spending. A ton of Cisco's customers went bankrupt. Capital spending dried up. Meanwhile, Cisco was left holding billions in extra inventory they couldn't sell. They had to take over a $2 billion write-down, which back then was a ton of money. And that's why I say this. NVIDIA could very well be today's Cisco. There were also allegations of revenue. How did they report revenue back then? You guys saw what Michael Burry said recently. He even said, NVIDIA is not Enron, it's Cisco. And guess what? Cisco survived. It's a better company. Now I'm going to show you something else that's very interesting. If you look at this point right here, and you look at this point where we're at today, the stock price is up about 10x. Where do you think profit is? It's up about 10x. If you take out this garbage right here, and people who've seen my videos before see me do this, this looks like a pretty solid company that is pretty reliable, doesn't it? You cannot judge a company by the short-term price fluctuations that the market gives it. You cannot do that. If this to you means successful and this to you means failure, you're probably not going to do well in investing. But if you've made it this far in this video, it tells me you're here to learn a different way of thinking. Now, I'm not saying NVIDIA is going to crash tomorrow, but the story feels familiar. Everyone loved it. Expectations are sky high. You're crazy if you don't own it. Valuation is stratosphere. And just like Cisco, it's being priced as if nothing can go wrong. That's the warning. Not about NVIDIA specifically, but about any company getting priced for perfection. Cisco proves something that most people forget. Even a great business can be a terrible investment if you pay the wrong price. If you pay too much, the best story in the world becomes a bad investment. Now, let's flip Cisco's story back on its head. If you were a value investor back in the early 2000s and you looked at Cisco when it was flying high, you saw the hype, you ran the numbers, you said, nope, too expensive. Guess what? You avoided this pain. Yes, you might have had pain feeling stupid for this, but you avoided that. This is far worse than missing out on this. It's far worse to experience a 90% drop than to miss out on 800% gain. But here's the part that no one talks about. Let's say you stuck around. You kept watching. And a couple of years later, Cisco falls to $8 a share. The hype is gone, the dust has settled, and suddenly the stock's underpriced based on the actual business. Because guess what? $8 a share here, but at its point right here, it was $8.40 just 6-7 years earlier. And guess what? The business was bigger, higher revenue, higher profit. Well, if you bought it back then and you held it, you'd have nearly 10x your investment and your money over the next 2 decades. Why? Because Cisco's profits also went up by that amount. The business kept growing, even if the market overreacted temporarily in both directions. This is exactly how I look at NVIDIA and Tesla and other companies today. I don't own either company right now, not because they're bad companies, but because they're overvalued. They're priced absolutely for perfection, in my opinion. But one day, I will be the guy sitting here saying, you know what? This is the time to buy. You know what people will be saying then? Paul, you don't get it. Here's all the news that says this is a bad company. Okay. If the price falls below intrinsic value, I will become a shareholder in all likelihood. That's what value investing is all about. You wait, you stay patient, you compare price to value. When price is above value, you stay away. When price is below value, you start looking at it deeper and make a purchase if necessary. Now, let's put this into practice. Remember earlier, we mentioned that 24 companies in the S&P 500 are currently down 30% or more this year. Well, let's pick one of those and break it down together. We're going to look at why the stock has fallen, what the market might be reacting to, and most importantly, whether it's a real opportunity or a red flag. This is a skill that matters, guys. It's not just about seeing a big drop and thinking, oh, it's on sale. No. Yes, it might be on sale, but the stock going down doesn't mean it's cheap. You need to know why the stock fell, what the business is really worth, and if the price you're paying today makes sense based on future cash flows that you estimate. So let's dive into the numbers, look at the story behind the fall, and decide, does the stock deserve our hard-earned money, or do we pass on it? That's what I'm going to look at right now and show you guys. So, guys, I didn't even know this, but one of the 24 companies is Target, a company that I own. I literally did not know this is the company we're going to do today. So, I own the company. Don't buy it just because I have it. I cannot be more loud about this. Just because I or somebody else on the internet or even Warren Buffett owns a stock, that's not the reason you should buy it. Cloning is something to emulate in the sense of, oh, they like this company. Let me go look into why they like it and see if I see the same things. That's not investing, guys. If you just follow somebody's trades and do it. That's following blindly will have you lose money. Because the same follow blindly here, no different than somebody out there, your neighbor's friends, dad's, uncle's, former boss says you should buy blah, blah, blah stock. Your job as an investor and our job as a channel is to help you think for yourself. We want you to use logic. We want you to run the numbers, understand the business. Guys, if you go look at the best value investors out there, their portfolios are massively different. And they're going to disagree on things, but they do well because they find value in areas they find value in that make sense to them. We're going to do this together. So what is going on with Target? Well, the stock is taking a beating this year. Let me pull it up right here in our software. Year to date, it is down 30.86%. It's currently at $91 a share. Guys, $91 a share means nothing. That means nothing right now. Saying 91 a share versus Nike at 60, it's not 50% more. That's just a representation of how they divide the entire company's worth by the number of shares they have. Berkshire Hathaway is $800,000. It's not worth, $88,000 more, 8,000 times more than Target. This stock has taken a beating because consumer spending is down, and Target is kind of a luxury in that world for clothing, home decor, all the non-essentials versus something like Walmart or TJ Maxx. People are stretched thin right now, and that's going to hit these kind of brands like Target hard. They went through an issue when it came to theft. Their same-store sales have been falling. They've cut their profit outlook multiple times, and margins are shrinking. Why? Price markdowns, higher costs, and on top of that, rising tariffs have jacked up sourcing costs even more than they expected. And let's not forget the cherry on top. CEO Brian Cornell is stepping down, and the new CEO pick, an internal hire. Wall Street wanted someone new with a bold plan. Instead, the market shrugged and the stock dropped. Target is trading at a much lower valuation than competitors like Walmart or Costco. And that's because the market sees this as a business with real ongoing challenges, not just a bump in the road. But here's the question I'm asking as a value investor. Is the stock now undervalued based on its future potential? Because some people out there, and I'm talking about serious analysts, not YouTubers, see this as a potential long-term opportunity. Guess what? I couldn't even care less what they think. If Target can stabilize, if they can remodel their stores, grow online, fix its supply chain, the upside is real. But it's still a big if. Now, why do I look at Target? Well, guys, I ask the females I know, do you like Target? And invariably they all say, yes, we love going there. It's a joke amongst on Instagram and seeing your wife go to Target and blah, blah, blah. So I look at it and say, okay, do I think Target will be around for the next 20 or 30 years? Yeah, I do think that. Is retail changing? Absolutely. Is Amazon, have they taken away market share? Sure. But people still like to go to the store and shop, and Target's a great place for a lot of women to go. So the answer is yes for 20 or 30 years from now. So the next question is, do I think they'll make more money 20 or 30 years from now than they are today? The answer to that is yes, because of costs going up, people's incomes going up. Everything will get better, and I think they'll make more money. So the final question, can I pay a reasonable price today that factors all that in? And since the stock has fallen 30% like Target has, it means it's an opportunity to sit there and say, well, if all those answers are still yes, then this makes it 30% cheaper. What's ironic is the all-time high in the stock was $236. $236 back in 2021. That's what's amazing to me, that people back then probably thought the world is awesome for Target. And now when the stock goes down, people think, oh, this is terrible. News follows the stock price. But we need to understand what the business is worth right now and where it's likely going. And I'm going to go show you exactly how I do that next. So guys, $41 billion market cap, $82 billion enterprise value. That difference is their debt has a lot of leases in there. Now, their 5-year average free cash flow was $3.07 billion. Last year was $3 billion. So it's pretty much on par with the last 5 years. Not much, no growth whatsoever. Guys, people who love dividends, it's paying a 5% dividend. I wouldn't get too excited about that. They eat up 2/3 of their free cash flow. If the business continues to struggle, this is going to go away. In fact, if I were the CEO right now, I'd be like, yep, bye-bye dividend, we're buying back shares. The company's selling for 13.5 times free cash flow, 11 times earnings. Buy back shares. Dividend is a waste of time. Yes, it'll hurt the stock price. It'll make the stock even cheaper, and I'll be buying back more shares at an even cheaper price. That's smart capital allocation. I'm not saying this is going away, but if the business does get worse, that should go away. Profit margin last year, 3.6%. We talked about lower margins because in the last 5 years, they've averaged 4%. And their revenue growth rate, -1% a year for the last 3 years. These are issues with the company. The good news is they tend to make a high return on the money when they invest it in the business. They tend to make about 14% a year. That's a sign of a business that has good economic profits that can be built as time goes on. If you could always invest your money into your business and it generates 14, 15% a year, you're going to make amazing amounts of money in your company. It's going to be worth a ton of money someday. That's really important. So let's go to the 8 pillars. Ironically, not an 8-pillar thriller. Net income's down. Free cash flow is down. Revenue's up. And a lot of debt here based on this. So poop city. Now, again, this is consistent with a business that's kind of struggling right now and turning itself around. That's very consistent with it. So guys, you saw these key metrics. You see all these things I'm doing. It feels overwhelming. I don't blame you. Do me a favor. If you want to get all of these key metrics and understand them and apply it to other companies, I've got a great cheat sheet that I created absolutely free. Click the link below. In a matter of minutes, you'll get this free download sent to you. It'll send you all these metrics, what they mean, why they're important. That way you have it in front of you. As you look at companies, you can sit there and understand what's going on. But more importantly, when you talk to your friends about investing, you're going to be the smartest person there and be able to brag. As you talk, their returns on capital aren't very high, or their returns on capital are very attractive. That's also a nice benefit to it. Now, I talked about analysts earlier. Analysts do see this decline, a 15% drop in earnings per share, but growing, and 4 years later being up 50% from today. Now, are they right? I don't know. I hope so. What about revenue growth? Again, a drop and start to climb back up to normalized inflation rates, 3 to 4% a year. So again, not a grower, but if you can buy it the right price, even a slow growth business can be a great investment. Now, before we break down what price I'm going to pay, I want you to realize one thing very important. Most investors lose money because they're trying to pick the next big winner, the next big NVIDIA, the next big Tesla. The best investors do the opposite. They eliminate the losers first. That's what I'm trying to do here when I analyze a stock. I'm trying to find the reasons why this glares at me and goes, don't do this. And first and foremost is usually valuation. But I also want to avoid a bad balance sheet. Like, they have too much debt. Now, Target has a lot of debt, but it's retail. They have to pay these leases. That's kind of necessary for their business. I don't really look at that as much as debt. But now I'm going to take the story and some numbers and put them together, and I'm going to use it in our stock analyzer tool. This is what allows me to say, okay, I'm going to make projections for the next 10 years. I'm going to sit there and say, hey, I think this is going to be revenue growth. This is going to be profit. This is going to be the market multiple. And then what return do I want? It's going to tell me, if you want all of these things to happen, this is the price you got to pay. So let's sit there and pull up the last time I did target in my assumptions. All right. I'm actually going a little bit more conservative. So guys, I did first revenue growth numbers. I did 2, 3, and 4% a year for the next 10 years. Nothing crazy, just normal steady growth. Profit margin, I did 3, 4, and 5%. And I kept it the same with free cash flow, even though free cash flow has been lower in recent time. Okay, now, what's the PE and the price of free cash flow I would assign to target 10 years from now? Well, we all know the market average is 15 to 16. So guys, what I always say is, good companies, you should give a higher multiple. Bad companies, a lower multiple. What that means is you should be willing to pay more money for a good company and less money for a bad company. Now, yes, the stock is down a lot, but I still think Target is a good company. And for that reason, I gave it 17, 20, and 23 times earnings 10 years from now. You might disagree with that. More power to you. The whole key is putting your assumptions in here to sit there and figure out what's the right price for you. And then finally, what is your desired return? Now, guys, when I'm trying to figure out intrinsic value, I'm trying to figure out what's this company worth to the market. I'd put in the market return of 9 or 10%. But when I want to buy a company, when I'm actually looking to pull the trigger, I need a higher return than that because I need to have a margin of safety. And if I just want market return, what should I do? Just buy an ETF. Now, here's the cool part. In our Everything Money community, this is exactly the kind of stocks that we talk about. We dig through the noise, we find the ones that's fallen, and we figure out which one of them are true opportunities. And they're back and forth. Guys, there are thousands of people in this community all having different opinions of things. If I went in the community right now and talked about Target, there'd be people saying, I'm avoiding it. There'd be people saying, hey, it's awesome. In fact, if you go look at our main page, our average community member has it as a buy and an intrinsic value of 101, but there are still hold and sell people in our community. That's what's great about having a community of people. 25 years ago, guys, I was chasing hot stocks. I was following tips. I was getting caught up in the hype. But that's not investing, that's gambling. And I learned that the hard way. That's exactly why I created Everything Money. I wanted to give 20-year-old Paul the tools, the strategy in the community that I never had. So when you join EM, you're not just getting this powerful investing software, which we've only just scratched the surface on in this video. You're getting a foundation. We integrate you into the community by offering you free courses that we all have the same foundation and get you engaged in our community of like-minded investors who all want one thing, to level up their investing so you have the right mindset and support alongside the software and tools to sleep better at night and get better results. This isn't for everyone, guys. It's just for the right ones. So if you're committed to investing the right way, start your 7-day trial today. Click the link below. We limit the spots every day. So if you're serious, I'll see you inside the community. And that's very important, guys. Only if you're serious about being an active community member. We don't want the people, the fly-by-night people looking for a handout. We want people who are trying to level up their community, their investing abilities. So I put in my inputs. I hit the analyze button. The stock's currently at 91. This is why I'm interested in Target. The stock is down 30%. I have a low price of 106, a high price of 250, a middle price of 170. So the way I look at this is this. If I believe Target's gonna be around for a long time and their profit's gonna be higher in years to come, this is probably an opportunity for me. And keep in mind, this current price return includes that 5% dividend. So if it goes away, these numbers don't change. Now listen, just because a stock falls doesn't mean it's suddenly a deal. I'll repeat till I'm blue in the face. Cheaper does not mean cheap. And just because you bought it doesn't mean it's going to magically stop dropping. Stocks don't know you own them. They do not care that you own them, and they don't care what price you paid for them. You need to be confident before you ever click the buy button. If you truly understand what you're buying, you'll expect some volatility. You're not going to panic sell when the market dips or a stock you own has fallen. And you won't chase hype when prices soar. That's how you survive market crashes and avoid the biggest mistakes that most investors make, which is selling low and buying high. And don't forget, a stock can and will drop 50%, and it can still be overpriced junk. That's why understanding valuation matters. That's why principle-driven investing matters. When you know and understand the value of a business, when you have a plan, you can spot better businesses and great businesses and wait for those rare chances to buy them at amazing prices. Now, early this year, I picked 7 stocks to start the year to go head to head with the true Magnificent 7 that everybody has grown to know and love. Click on the video on your screen to see which 7 stocks I picked and how they stack up. Guys, the results might surprise you. Thank you for your time.